All right, well, welcome. Sorry for the little technical difficulties there at the beginning, but I think we're finally all set. So, this is a plenary symposium, Causes and Consequences of the Global Financial Crisis. We have three presenters today. Our first presenter is our president, Asli Demirgök. She's a director of research at the World Bank, and she is also a former invited speaker from one of our previous conferences, and obviously she gave her presidential address this morning. I hope everybody here was able to hear it. It was quite good. Her talk today is Rethinking the Role of the State in Finance. So would you like to begin?
Thank you very much, Kathy. All right, so this is let me just tell you a little bit about the motivation of this talk. Again, this is based on another one of our global financial development reports. Actually, it's on the inaugural one. The reason we've done this work is because after the global financial crisis, there was a lot of questions about the validity of our policy advice in the financial sector. Certainly, the crisis revived the notion of a much bigger role for the state and in state interventions, helping stability, growth, and jobs. And a lot of our client countries came to us asking whether now we've changed our mind about many of the aspects of the Washington Consensus. So this was an opportune time for us to put together a new series of reports where we sort of each year we focus on a certain feature area which is of policy relevance and sort of bring together, synthesize a lot of the conceptual framework theory and empirical evidence to draw out the policy implications of the work. And as you've heard this morning, we've talked about financial inclusion, which was the second in the series, and this was the first one where we talked about the role of the state in the financial system. But these reports are much more than just the policy discussion. There is a whole range of databases tied to the report, actually for over 200 countries since 1960s. There's a number of sort of financial sector development indicators many of the researchers and policymakers use to do research or to do benchmarking of financial systems. So if you haven't seen it, I do urge you to go to the website and take a look at both the database and the various studies associated with it. So let me just go right into the feature topic of the first report. As I said, we wanted to take another look at the role of the state in finance. And in doing that, we did conduct an informal poll of our financial sector experts from all around the world and asking them questions about the financial sector policy after the crisis. And what was interesting to us is that there were many, many areas of disagreement about regulation and supervision, about competition policy, about ownership of financial institutions, even about the role of the state in promoting information environment. So what we decided to do is we decided that it's really generally after a big financial crisis like that, there is a lot of pressure to reform. But the biggest problem is that there is also a very big risk of drawing the wrong lessons from the crisis because in an effort to reform and reform fast, sometimes both the policymakers, even the academics, tend to have little time, analyzing, investigating, writing learned papers, and yet, in order to reform, may jump to various conclusions. So we thought that 4 or 5 years after the Lehman crisis, the report intends to really take a step back and reevaluate what we knew about these issues before the crisis, what the crisis taught us, and where we go from here in terms of policy advice. And there are many areas, obviously, of financial sector policies that's relevant, but we decided to focus on these 4 areas where we saw the biggest sort of disagreement and discussion around financial sector policies. One, regulation and supervision. Second, competition policy, particularly in banking. Third, direct state interventions, again, particularly the role of state ownership of banks. And 4, and finally, the information infrastructure. We touch on that. Okay, so the role of state as regulator and supervisor, this is certainly an area where there is very little discussion as to state need to be involved. Clearly, there is a need for regulation supervision. It's much more, though, how to best ensure regulation and supervision supports sound financial development. So, as we all know, that there are many trade-offs here. If you have too much regulation supervision, you hamper innovation and growth. Yet, if you have too little of it, there is the fragility crisis that comes along with it. So, the whole idea is not necessarily more regulation, but much more the right type of regulation, and that's where we try to make a contribution. And the main contribution of the report is really sort of an update of the World Bank survey of regulation supervision that was started almost a decade ago by Jerry Caprio and Ross Levine in the World Bank. In this, after the crisis, we were able to expand and update and sort of do this much more with collaboration of the supervisors. So there's about 730 questions that's answered in the survey and covering over 140 countries. And after the 2000, 2003, 2007, the 2011 version is really the update after the crisis. So using this database, we are able to look at particularly two questions. How does regulation and supervision and elements of market discipline compare in crisis-hit countries versus those countries that survived the crisis much more easily relative to the rest? And how did regulation, supervision, and some elements of market discipline change after the crisis in the individual countries? Because although we know all the international reform efforts, it's not as straightforward to see to what extent these things are trickling down at the country level. So what do we see? Very quickly, and this is based on a paper that just came out in the Journal of Financial Stability, actually, comparing the regulation supervision environment in crisis-hit countries versus other countries. And the crisis definition comes from Levin and Valencia, actually. We do see that generally those countries that were hit the most by the crisis had less stringent type of regulation with respect to capital regulation. They had greater reliance on banks' own risk assessments. There was less oversight of external auditors and lower standards for public data quality. And essentially, also certainly less scope for market incentives because of the generous deposit insurance coverage, too big to fail policies, and so on and so forth. So what happened after the crisis? Well, there were some efforts on macroprudential policy that you can sort of see from the survey on crisis resolution, consumer protection, effectiveness of many of which still require a lot more analysis. But clearly, there is a lot more room for improving the market incentives after the crisis and during the crisis. The safety net systems have expanded. There were even greater concerns about too big to fail issues. Even what we can draw out from the survey suggests that there is a lot more scope for improving disclosures and monitoring incentives. But what does the report and all the analysis that feeds into it suggest about the regulation and supervision? One of the important points is that when it comes to regulation, less can be more. Because having ever more complicated regulations to close every single loophole that's potentially there encourages even more regulatory arbitrage. So particularly when you think about developing countries where the capacity of supervisors is fairly low, then trying to adopt en masse all these regulations that are intended for developed countries may backfire in that context. So simpler but much more strongly enforced regulation tends to work better, particularly in underdeveloped institutional environments. And another challenge, clearly, is to introduce reforms that are incentive robust. And this is when it comes to regulation as well. And one of the suggestions in the report, another underlying paper, has to do with this new idea of incentive audits as a tool. And this whole idea is to put a special focus on the importance of incentives. For the most part, surveillance and regulation that would do, and also in these international organizations, has to do with focusing on auditing things like Basel core principles, auditing adherence to regulations. What we are suggesting is to really put the incentives much more front and center, and regularly and systematically evaluate structural factors that affect incentives for risk-taking in the financial sector. So that means that you really need to think much more broadly, not only on specific regulations and try to see if the banks adhere to those regulations. And when one looks at the impact of compliance with Basel core principles, there is very little evidence that these things are associated with outcomes such as more sort of less fragility, etc. anyway. And in terms of implementation, clearly this could be part of the macroprudential authority, but also it doesn't need to be put through from scratch, because a lot of the financial sector assessment programs that we do jointly with the fund already looks to some extent at the incentives. So to do this in a much more systematic fashion and incorporate it in our international oversight would greatly improve the way we track and sort of identify fragility, I think. All right. So in terms of the second area that we try to sort of look at and synthesize evidence, that had to do with the role of the state in promoting competition. Now, if you'll remember, after the crisis, there was a lot of discussion as to whether too much competition in the financial sector among banks was really the culprit for the fragility. A lot of the literature, the prior literature in this area, suggests that competition is associated with greater efficiency and greater access. But the evidence on the impact of competition on stability is somewhat mixed. So the question is whether too much competition really led to the crisis, and more importantly, is the right policy for the government is to restrict competition. So there was a lot of our client countries coming to us trying to figure out whether, as a result of the crisis, that what they should do is to remove or limit competition in the financial sector. Now, there is a lot in the report. Again, I urge you to go to the website and download some of the background work. But the gist of what comes out is that no, competition was not the culprit, because there's new research evidence actually looking at systemic risk as opposed to individual bank risk, and looking at how competition or lack of competition in this case is associated systemic risk of banks. So instead of looking at individual bank risk, you look at whether the banks are taking on more correlated risk. And there it's it's fairly clear that leading up to the crisis, there was actually greater market power, and this greater market power was associated with banks taking on more and more correlated risk. So there was a greater increase in systemic fragility. So what these results suggest, and which also makes a lot of policy sense to me, is that the role of the state is to actually improve market contestability, so healthy entry and exit, and the availability of credit information and contract enforcement to promote healthy competition. What leads to problems is the underlying environment and the distortions in the safety net, the too big to fail policies that actually may end up creating these negative consequences of competition, not the competition itself. All right. So, which brings me the third area, which sort of we summarize and investigate in the report, and this has to do with again direct state interventions, but particularly state ownership of banks, so public bank ownership. Those of you who are familiar with this literature will know that before the crisis, the conventional wisdom was that despite very good theoretical reasons for the existence of public banks, such as market failures and externalities, state ownership of banks in practice was associated with very poor outcomes, both at the bank level and the economy level, and most of it comes from governance failures due to politically motivated lending. So the conventional wisdom was that basically, to the extent politically possible, to privatize all the public banks because they were having negative consequences on growth and development over the long run. Now, what happened, though, as a result of the crisis is that this whole debate on the role of state-owned banks was reignited because with the crisis, there was a credit crunch, and a lot of the developing countries found it very convenient to use their state-owned banks to promote credit. So the question became, well, perhaps then these institutions are very useful as a short-term counter-cyclical tool, and maybe this type of a function is good enough to justify their existence in the long term. So we had to address this question because this was sort of completely overturning a lot of the policy advice that we were giving in this area for a long time. And it was interesting that when we did a huge literature review on the impact of state-owned banks on various outcomes, we saw that most of this work had to do with their sort of access issues, efficiency of lending, growth implications, and so on and so forth. Yet there was very little academic work that looked at the role of state-owned financial institutions over the business cycle. So we did this work. It's a cross-country work looking at over 100 countries for the period 1999 to 2010. And essentially, what comes out is indeed sort of state-owned bank lending tends to be less pro-cyclical. So it tends to be less pro-cyclical, and in countries where the institutions are stronger, it could even be counter-cyclical. So this comes out of the general sort of broad cross-country research. When you look at individual regions, you do see that there is some diversity. For example, in Latin America, you saw the countries acting in a counter-cyclical fashion, the banks, but in Europe, this was much less so. But when you delve deeper into this and try to see where the money went, it's very interesting because the money still goes to sort of connected lending type of activities, large borrowers that are connected to the state, and there is very little evidence that any of this retrenchment happens after the cycle ends. So in many ways, those sort of institutions that are in most need of borrowing, such as small and medium enterprises, etc., are not receiving this funding. So it questions whether this is really sort of counter-cyclical lending in its spirit. And obviously, when you make decisions like this, you need to really think about the long-term consequences. So the very solid and extensive literature on the long-term implications of sort of state-owned banks and their lending decisions makes it clear that this is a very difficult and this is a very dangerous policy to pursue and is not advised. So the issue is, in many countries still, many of our client countries, there is still a significant share of state banks in the banking system, and politically not feasible to privatize at this point. The question becomes, how do we make sure that these institutions really are run efficiently and they do an efficient allocation of credit across the board. And there we were also lucky to have a survey of development banks in 90 countries to figure out best practice cases. Now, interestingly, best practice lessons aren't difficult to come by. We all know that you need to have a clear and sustainable mandate as a state-owned institution. You need to have adequate risk management systems, sound corporate governance, and so on and so forth. But it's easier said than done. So in weak institutional environments, you find that these best practice lessons are not adopted. And it's very hard to really run these institutions in a solid manner in these countries. And it's a catch-22 in a way, because these are precisely the environments where the institutions are meant to sort of address market failures, yet these are precisely the environments where it's very difficult to do this well. So then the answer is not really that different in a way. These good governance practices are really challenging to implement in weak institutional environments, which makes it very questionable whether having a state-owned banks for just counter-cyclical policy type of activities. All right, so this brings me to the last sort of area where we've done some analysis after the crisis, and that has to do with the credit information sharing. Now, clearly, the crisis also brought to the forefront the importance of improving transparency in information sharing. And in this area, too, before the crisis, the conventional wisdom was that, both public and private provision of information exists. Generally, we don't care whoever provides this information as long as it is good quality, widely available, so on and so forth. But some of the work that we've done in this area also suggested that, particularly in concentrated environments, like in many of the banking environments where the banks are very concentrated, private information sharing is much less likely to emerge when, because of the monopoly rents. So in those particular circumstances, the state has an important role to play to kickstart information sharing. And we do see, for example, that the probability of emergence of information sharing when it is provided by the state, so credit registries, is not significantly associated with the underlying competition environment or the concentration, whereas for the private information sharing, the credit bureaus, the probability of emergence is significantly associated with this. So the more concentrated the environment, the less likely private information sharing emerges. Also, the state has an important role in increasing participation beyond banks to non-banks, because the wider the coverage, the more useful this information is. All right, so I'm going to cut it short and end here. As I said, there is much more information and details on studies on our website. But just to leave you with our main messages, basically, the point is that clearly state has an important role to play in the financial sector. It's always had an important role before the crisis, and it continues to have one after the crisis. But it is very important to recognize that there are important trade-offs in designing public policy in this area. Certainly, for example, direct interventions during the crisis may look like they've worked, but and in some cases they have, but as the crisis subsides, there's need for rebalancing towards less direct involvement. And the overarching theme in this area is the important role of incentives. So the challenge is clearly to better align private incentives with public interest without taxing or subsidizing risk-taking. And this is clearly a bigger challenge in a globalized and liberalized financial system. Thank you. Okay, so Charlie,
Let's try this. And then I think that it's pretty easy.
Yeah, you should be able to just close it and open them back up.
Mine's
So it's
right
not
there.
All right. So our next speaker is Charles Calamiris. He's current vice president of the International Atlantic Economic Society, and he's the Henry Kaufman Professor of Financial Institutions at Columbia Business School. His title is Fragile by Design, The Political Origins of the Banking Crisis and Scarce Credit, and we're saving all questions to the very end, so for all three speakers. Thank you.
Thanks, Catherine. Where Asla left off is a good place for me to begin, which is the state is a crucial part of banking, always has been, and that raises some interesting questions about what role the state plays in the fragility of banks and in the scarcity or abundance of credit. And so this book, and by the way, there's a flyer for the book in the packages that you all received at the conference. And there's a copy of the book. Thank you, Rafa. And so the book is a sort of deep dig into the history of 5 countries, and I'll talk about those a little bit, to try to enlighten us a little bit about how does politics and banking, how do they co-evolve, and what are the natures of the political constraints that keep banking systems from performing very well. So the first thing to note is that we're in the middle of an unprecedented pandemic of banking crises. We have never had the frequency or severity of major banking crises in any historical period that we've had for the past 40 years or so. And that is a very interesting fact. About half of the countries in the world have had one major banking crisis. Some countries, about 20% or so, have had 2 or more, some as many as 4. The United States, for example, is in this category, having had 2 major ones. And then there's some lucky countries that have 0 crises. Of course, one way to get 0 crises is not to have any banking systems. But there's a more interesting way, and there's a small group of countries, which I'll talk about in a minute, who despite having very abundant banking systems have managed to not have any crises. And so the idea, when you're looking at this is, well, let's see, banking crises sometimes happen a lot in some countries, sometimes don't happen at all in other countries. Banking crises sometimes happen a lot in some periods and don't happen a lot in other periods. That, by the way, is, I think, absolutely essential starting point for getting around some big mistakes that economists usually make. So I'm going to summarize the entire banking theory literature about crises, which I've contributed to and many, many others have, with this sort of what I'll call the economic perspective on banking crises. What causes banking crises? Well, a big shock. There's really never been a banking crisis without a big shock. Because after all, big shocks mean there have been some losses somewhere, and given that banks' assets are often opaque, we don't know exactly where they are, but there's some big ones. And then there's an inherent sort of notion of the fragility of banks coming from the combination of the opacity of their assets and their short-term debt structure. So the standard sort of economic explanation about where banking crises come from tends to say, well, look, if you're running, let's say, an insurance company, you may have a big shock and you may have some losses, but you don't have short-term debt. So you don't get a sort of banking crisis sort of feel from the unwillingness to roll over short-term debt. But if you're doing a lot of banking in your economy and you have a big shock, that's what causes a crisis. Now, I think there's a lot to this argument. That is, as a statement about the necessary conditions for a banking crisis, I think it's pretty good. But as a statement about the sufficient conditions for a banking crisis, it doesn't really get us very far. Because there are lots of economies for many periods of time that had really big shocks and lots of banking and didn't have a banking crisis. So this economic theory is incomplete. And now we're going to try to get into what sorts of things it might be missing. And I want to just emphasize again, we're in this pandemic now. If you went back and looked at a period that was very volatile, 1873 to 1913, economically very volatile, lots of banking relative to GDP, and yet very few banking crises, 6 insolvency crises worldwide, and they were actually fairly small compared to the 100 that we've had in the last 40 years. And 6 illiquidity crises, all in the United States, by the way, for a total of about 12 banking crises that would meet the current definition in the Levin-Valencia study, which is about 1/10 the banking crises that we're experiencing in the current era, with a severity in terms of the losses of failed banks during the crisis, maybe 1/7 as large. So very unstable times, lots of banking, not a lot of crises. And then there, as I mentioned, some countries, Canada's going to be the one I'm going to focus on a little bit today. Canada's always been a commodity exporting economy. It has volatile GDP. And it's had a lot of banking, as we'll see. But they've never had a banking crisis. So what's missing in that sufficiency criteria? And you might say, well, is it regulation? I think the answer is yes. That's a pretty good theory. And in particular, in a lot of work that Asla and other of her colleagues at the World Bank have done over the past 20 or so years, has been to show that the combination of protecting banks and not having effective regulatory regimes to control their risk-taking is the explanation for why we're living through a current pandemic of banking crises. And Asla's book that I mentioned around noon today during her speech, Deposit Insurance Around the World, is a great place to start if you're not aware of that literature in looking at where protection came from in the 70s and the 80s, especially worldwide, and what effects it's had. So, yeah, I think we've got a good place to start answering this question. It has to do with setting up unsustainable risk-taking governance environments in which banks are taking on too much risk because they're protected and there's no control over the risks that they're taking. Good theory, I would say, but that just begs a deeper question. How come sometimes didn't do that? How come some places don't do that and other times and other places do? Is it just random? Because after all, the problems in many problem countries are persistent. And the lack of problems in other countries are also persistent. Banking's not rocket science. You could learn what's causing these problems, and you could, if it were just a matter of learning what the problem was and solving it, we would have solved it. We wouldn't have these sort of persistent problem countries or these other countries that seem never to have needed to learn. So the view in our book is that political alliances form in countries differently depending on the initial conditions of the country's settlement and constitutions, which make those countries more or less susceptible to these very destabilizing kinds of bargains. In other words, in some countries, the political groups that are in charge of the banking system are willing to accept instability, even though instability might seem like a bad idea. They might be willing to allow it as the price that has to be paid for the particular advantages they want to get. You might say the most obvious example would be large banks might be willing to accept instability in exchange for too big to fail protection because they benefit a lot from it. But that kind of thinking, we argue in the book, is too simplistic. Banks by themselves are never alone in these political coalitions. They involve other coalitions which typically include borrowers, both in democracies and in autocracies. And so deeply looking at how these political coalitions are formed and why in some countries constitutions and initial circumstances have led to a kind of persistence of dysfunction in banking coming from the way the politics works, we think is really an important part of this story. Now, the other sort of dimension of dysfunction of banks is credit scarcity. And here, too, this isn't rocket science in the sense that historically we've certainly known how to create abundant commercial bank credit since the mid-18th century in Scotland. In fact, all of the basic tools of commercial banking were developed fully by the middle of the 18th century in Scotland. So it's not like this is very difficult technologically. And yet, despite the fact that Scotland managed to go from, let's say, being a very poor country with no banking system circa 1700 to a fairly well-off country with a very developed and innovative and deep banking system that really has been the foundation of a lot of the technology of banking. Despite the fact that we've all can learn from that, many countries don't seem to be able to get there. This is from the World Bank database looking at the level of credit to GDP, and you can see that we group the countries into the 4 income groups. So you can see, though, that if you're very down toward the end, so in poor countries, they tend to have lower credit to GDP. That's true. But if you're in the Democratic Republic of the Congo, you can't really measure the size of the banking system because it's so small that it's virtually non-existent. So it's not just the level of GDP. These are credit to GDP ratios, and it's not just even for the standpoint of credit to GDP ratios, the level of wealth in the economy. There's a lot of heterogeneity within these categories. For example, here's the UK, here's Canada, and here's the US. All rich countries, but very different kinds of banking systems. And then here's Brazil and here's Mexico, and those are the 5 countries we're going to look at. From the very beginning, roughly 1700, even earlier, we're going to look at how the political environment has evolved with respect to banking in those 5 countries, and how that can explain why they differ in terms of the abundance of credit over time and also their relative instability. These are countries that are going to be primarily autocracies during our period. They're very different kinds of autocracies. And these are countries that are primarily democracies during our period, but also very different kinds of democracies. And so we picked these examples, knowing a lot about them before we wrote the book, because in some sense we believe that they span really pretty much the full range of possibilities in terms of different kinds of political regimes, and they have very different kinds of experiences. Now, I'm only going to be able to go through this very quickly and give you just a very quick sort of sense of how this is connected to the current behavior and the current pandemic, and in fact the most recent crisis. But let me just start by pointing out, if you go sort of 1 standard deviation above the average of the credit to GDP ratio, which is historically not that big ratio of credit to GDP, but let's just call it sort of a normal functional credit to GDP ratio, and you say how many countries have that level on average and also no banking crises? And the answer is only 6. 3 of them are island states or city-states, Singapore, Malta, and Hong Kong. And 3 of them are countries that have a very interesting common features in terms of their constitutional history. And so what we would say is that what these all have in common is they're places where political coalitions don't tend to be very easy to form to exclude large chunks of the population. Because if you're going to have political coalitions using the banking system to favor themselves at the expense of others, they have to be able to exclude large chunks of the population. If you're in a city-state or an island state, it's very hard to do that because the population tends to have consonant, sort of homogeneous economic interests. And if you're in what we're going to call a liberal democracy, where Canada and New Zealand are particularly good examples of this, they're structured in ways that basically try to create what political scientists call veto gates that limit the ability of coalitions to use the government powers to create banking mechanisms or other economic policies that extract benefits from some segment of the population to serve another. So the point, we think, is, especially when we're talking about what are mainly democracies here, that democracies can achieve stability and abundance of credit. By the way, they achieve them better than other countries do. This group is 5 of the 6 of them are democracies, we would say. But what's interesting is that they seem to be able to achieve them in environments where, either because of their exogenous circumstances of being a city or an island state, or because of their constitutional structures, they're limiting the ability of the political system to deliver a divisive kind of control of the banking system which favors some at the expense of others. Now, there's a flip side to this. If you use the same database and say, Where are the basket cases? That is, they've had at least one crisis and they have very low credit to GDP. And what you find is they tend to be autocracies with the worst kind of political governance and corruption histories, often violent histories. And so we think that that's also quite interesting. And we go through in the book at length talking about why it's so hard for autocracies to develop banking systems. And let me just give you a quick answer. There are two answers. One of them is, for centralized autocracies like Mexico, the problem is that any autocrat who has a huge amount of power as a centralized autocracy is somebody who can take your money away from you arbitrarily. And that means that setting up a bank may be something that's not very attractive. You may want to form an alliance. Sometimes it's called crony capitalism, but even these alliances can be unstable. And if you look at the history of Mexican banking, it's largely a history of expropriation risk. So expropriation tends to limit the voluntary contribution of capital to the banking system and create a new equilibrium of sort of crony capitalist limits to entry that create enough returns so that the cronies are willing to participate in the banking system. But that tends to be very scarce. The other kind of autocratic outcome is the Brazilian outcome. That's a very weak power autocracy where their central government has been weak historically, and where the central government has a lot of tax problems, tax collection problems because of its weakness. And so what the central government does have control over is the chartering of banks. If the only thing you have control over is the chartering of banks, how are you going to pay for the cost of government? You're going to use something called inflation tax banking, because it's the only way you can raise taxes. And that will pretty much rule out, in the periods that you're using it, any private credit creation in the banking system. Again, in the interest of time, I'm not going to go through all that. The point is, just like there's heterogeneity within the democracies, so we get abundant credit in all the democracies pretty much, but then we get some democracies with unstable credit, like the US, in contrast to stable credit, like Canada. In the autocracies, we also tend to get both instability and low supply of credit, but the autocracies also have variety within them. Centralized autocracies, sometimes called crony networks, have a particular logic of dysfunction, whereas weak autocracies have their own logic of dysfunction. All of them are bad news in terms of the creation of stable and abundant private credit. So in other words, we're talking about banking, and we're not really talking much about economics here. We're talking about political systems that, because of deep and hard to reverse exogenous differences, find that they create very different kinds of outcomes. So these are the basic patterns in terms of the differentiation. Autocracies are not good news. Democracies are better, but with a lot of variation in terms of stability. And so now let's, in our remaining 5 minutes, talk a little bit about one case, the U.S. versus Canada. The U.S. has had since 1790, depending on how you count, 17 to 20 major banking crises. Since 1840, 12. Canada, since 1840, has had 0, including the current period that we're living through. And by the way, prior to 1840, also 0. So, as I said, this is very puzzling. The private credit to GDP ratio in Canada has been comparable to, or in the more recent 30 years, in excess of the United States. These are data that we collected ourselves because, by the way, in some of the databases, in particular the numbers for Canada and the US, those comparisons we didn't think were quite right. So we created these data ourselves for the book. And so I've already talked about our framework. So I just want to, and I've already talked about that. So now, what's going on in the United States? Why is the US this incredibly unstable environment for banking? So we go through the development of the US banking system from the standpoint of 3 political eras. The first one, which is a kind of monopolistic and crony chartering era, sometimes called the Federalist era, which is where very few banks are existing, and they have other than the one bank of the United States, they have monopoly reign within the states that they're operating. that's not really a sustainable equilibrium under American sort of populist democracy. And so starting in the 1820s, and certainly by 1830, really going until about 1980, a new equilibrium develops of entry, but not really fully free entry. It's called unit banking. So the way that works is each state has banks chartered within it. You're not allowed to operate across state lines, and you're only allowed to operate in almost all the states one office, no branching. What? Everybody knew that this was a terrible way to run banks. They're not diversified. They're not cost efficient. They're not competitive with one another because the overhead costs of setting up a branch are so great, of a bank are so great that you get very few banks ever competing with each other. But it was a very long-lived, sustainable partnership. Why? Because two parties were very involved in keeping it that way. One were the unit bankers themselves once they came into existence. For obvious reasons, they got monopoly rents. But the other, less obvious one was the agrarian populace. Unit banking was the platform, on the major presidential platform of William Jennings Bryan, for example. So we explain in the book why landowning farmers liked having banks that had to lend only in their own communities. It was a way to basically share the downside, since those people, those farmers, were very beholden to the weather and also to crop productivity. If soy prices and production fell, having a bank that didn't have options outside of lending in the soy producing area was actually somewhat beneficial because it meant the bank would be more understanding to you. That's not efficient, but it might be a form of credit insurance that you would take, despite the instability that it brings for the whole economy, and despite the fact that it keeps manufacturers from being able to have the kind of access to credit they need. This gave way, and I won't have much time to talk about it, with big shifts in population from rural areas to urban areas in the United States, and the collapse of the unit banking system, which had a technological component and some shocks and some other things, gave way to a new equilibrium, which was where the banks were now going to be allowed to merge on a nationwide basis in the early 1990s. It started in the 1980s. But the issue here, of course, is, well, who gets to decide who's going to become those new mega banks, now called too big to fail banks, that are going to dominate the scene? And that's a political negotiation. And so the political outcome was largely urban activist groups who would be called upon to testify at the Fed merger hearings. If they didn't want the bank to merge, it wasn't going to merge. And so they were given by Congress a sort of veto over the mergers, which meant the deal worked out sort of like this. So the mega banks are going to be created. They're going to get huge market power benefits, too big to fail status, as well as scale and scope economies and efficiencies. And they're also going to be given, as we now know, very weak prudential regulation. That's all part of their rents, their advantages. But they're going to have to, if they're going to get that, they're going to have to sign agreements sharing those rents to a very large extent with the groups that are giving them permission by testifying at the hearings and saying that they should be allowed status to do it. How big are these benefits that they're sharing? I think some of you will be surprised how big they are. So the total amount of contractual commitments that the banks signed as a quid pro quo for the activist groups showing up at their hearings from 1992 to 2007 was $867 billion. And there was another about $2 trillion of voluntary commitments too. This is not a small amount of money. The rest of it I'm not going to go through because I've run out of time, but just to say that having to meet the standards associated with this actually has a lot to say about what led to the declining underwriting standards in the mortgage market. Again, I apologize for not going into all the details of that. And then a question is, and this is the last minute that I have, why didn't Canada choose the same path? And the answer is that Canada is growing up as a British colony where the Brits are trying to avoid there what happened in the U.S. And they have all along, since they won Canada in 1759, a hostile interior force called the French Canadians. And so the British designed Canada ultimately, starting in 1841 and then in 1867, as a liberal democracy, precisely so that they can create political structures in their constitution, in their Senate, for example. The Senate in Canada is still appointed by the Queen of England, and unlike the House of Lords, still has full authority over money legislation. They design a system with veto gates that actually works very well in pushing back the populist agrarian pressures that were present in Canada too, but that succeeded in the US but continued to fail in Canada during the 19th and early 20th centuries. So, last slide, broad policy takeaways. Banking is always going to require the active encouragement of the state. The state has power over banks. Banks need the state, and the state also needs banks. Debates about regulation that we economists engage in are often kind of silly, because the real question about regulatory reform is, will the political environment tolerate it? Will the political environment be one that's conducive to it? And the sad truth is that if you're living in a country, let's say like the United States, where we've had 17 to 20 crises, depending on how you count them, there's really not a very strong argument from this basis to believe that we're not going to continue to have them. And on that depressing note, I'll turn it over to Rafa.
Okay. Our third presenter today is Rafael Rapullo. His talk is Countercyclical Regulation. He's a professor of economics and director of the Center for Monetary and Financial Studies. He's a fellow of the Econometric Society and the European Economic Association. He's a research fellow at the Center for Economic Policy Research, and finally co-editor of the International Journal for Central Banking. Thank you.
Well, thank you very much for the invitation. I'm the local guy in this panel. I want to talk about counter-cyclical regulation, and I have a question mark there because, as you will see, it's not clear that what we've been doing in the last few years is really trying to address counter-cyclical. Okay, this is the outline of what I will do. I will start stating what's the procyclicality problem. Then I will very quickly go over what do we find in Basel III, the agreement that the Basel Committee put in 2010 as a response to the crisis. I will more specifically look at the countercyclical elements of Basel III, the so-called countercyclical capital buffer. I will say something about forecasting financial crisis, which provides the background for the countercyclical buffer of Basel III, and then I will relate this variable, the credit to GDP gap, to the business cycle, and I will conclude. The procyclicality problem, very quickly, I guess that this is something well known to all of you. In the beginning was Basel II, and the objectives of Basel II, the agreement that was reached in 2004 by the Basel Committee, was to have a better alignment of capital requirements with bank risks, which sounds reasonable, and also to provide incentive for improving risk management. The closer relationship between capital and risk makes perfect sense in a cross-section, but it has unfortunate consequences in the time domain because risk-sensitive regulation is by definition almost pro-cyclical. Why do I say that? Well, think of what happens in a downturn. In a downturn, bank capital is likely to be eroded by losses, borrowers are going to be downgraded, then the banks will be required to have more capital because they have a riskier portfolio, then it is difficult to raise fresh capital in bad times typically, so the banks will cut back on their lending, and in the end we are going to have a worsening of the downturn. So this is this amplification effect that comes as a consequence of this feature of risk-sensitive regulation. Now, what was the response of the regulators when a number of people pointed out that Basel II was going to have these consequences? Well, basically, I would say that it was an almost complete neglect. And I'm quoting here Jaime Caruana, which was governor of the Bank of Spain, and he was my boss, actually. And he was also at the time the chair of the Basel Committee on Banking Supervision. And basically what he said is that all these pro-cyclical effects of Basel II had been exaggerated, basically. So, I mean, he was not very worried about this fee. Now, the surprising thing is when the crisis came and the G20 got acting as a response to that, they were surprisingly aware of this issue of procyclicality. And for example, in the London summit of April 2009, and something similar was in the Washington summit, then they stated that until recovery is assured, the international standard for the minimum level of capital should remain unchanged, and where appropriate, and this is what I have in bold letters here, capital buffers above the required minima should be allowed to decline to facilitate lending in deteriorating economic conditions. Well, that's pretty amazing, actually. I mean, I presented a paper on procyclicality in London, and there was a guy in the audience that said, yes, I wrote that. I was a member of the team that was working for this G20 summit. Anyway, so then as a response to this situation and the G20 mandate, what do we find in Basel III? Well, if you look at the document that was agreed in 2010, there are the following objectives in terms of the procyclicality. First, to dampen any excess cyclicality of minimum requirements. Secondly, to promote more forward-looking provisions. Third, to conserve capital, to build buffers that can be used in stress. And finally, to protect the banking sector from excess credit growth. What do we find in the Basel II document? There's nothing on the first objective, nothing on the sort of smoothing the cyclicality of minimum requirement. There is nothing on forward-looking provisions, partly, I guess, because of the conflict with accounting regulators. On the capital conservation side, yes, there is something which is very nice, the capital conservation buffer, which is basically in the spirit of the prompt corrective action of the US legislation. And finally, on the protection of the banking sector from excess credit growth, we do find something called the countercyclical capital buffer. So what is the countercyclical capital buffer, and what's the role of something called the credit to GDP gap in this buffer? Well, if you read the accompanying document, which is called the Countercyclical Capital Buffer Guidance, it has the following objective. The primary aim is to use a buffer of capital to achieve the broader macroprudential goal of protecting the banking sector from periods of excess aggregate credit growth that have often been associated with the build-up of systemic-wide risk. Well, sounds good. How does it work? Well, it in particular is an extension of the capital conservation buffer. It adds 2.5 percentage point of requirement on risk-weighted assets. And of course, if you are below, it works like the capital conservation buffer. You are restricted to pay dividends and to share repurchases, etc. What about internationally active banks? Basically, you compute a weighted average of the requirements across the different jurisdictions in which these banks operate. And the key thing that I want to discuss is what's the reference point for taking the buffer decisions. Well, the Basel Committee decided to select one indicator, which is the aggregate private sector credit to GDP gap. So let me now comment what's the how do we construct this credit to GDP gap? Now, I'm going to use, I'm sorry about the math, the notation. CT is going to be the private sector credit to GDP ratio. C bar is just a trend that you compute using the Hodry-Prescott filter. The XT is the gap, the difference between the level of the credit to GDP and the trend. And finally, B of XT is the countercyclical capital buffer. It's the extra capital that you have to hold as a function of the credit to GDP gap, right? Okay, the additional capital requirement has this kind of formula which is piece linear. Let me not bother about this. If you're below, if the credit to GDP gap is below this value L, then the additional capital that you are required to hold is 0. If it is higher than H, this upper bound, then you are at the maximum 2.5%. And in the middle, you just have a linear relationship. So the values of L and H in the guidance document are 2% and 10%. So that would be the kind of structure. It's a piecewise linear function. If you are below L, the credit to GDP gap is below L, you have 0 additional capital requirement. If you are above H, you have the maximum 2.5%, and in the middle is just a straight line. Okay. So let's look at one country, for example, Spain, and look at what happens to the credit to GDP. Well, actually, just before the crisis, we were almost 250%, okay? And you have huge bubble here that you can see in credit. If you plot the trend, the Hodry-Prescott trend, you have something like that. It lags the value, as you can see here. So they actually cross here. And if you compute the difference between these two lines, then you have the credit to GDP gap, which is that feature. So it's kind of very low, below zero, around zero, and then until you get to the bubble, then you have the collapse, and then you have this thing coming down. Now, these shaded, I don't know if you can see them, are the crisis periods that we have. We have a big crisis in the 1980s, and then we have, of course, the crisis that we lived after the Lehman Brothers. Now, where do you find the 2% and 10% bars? Well, you find them here, right? Now, look at, throughout the earlier part of the sample, we were below the 2% line, right? So, in fact, I mean, you would not have built any buffers prior to the first crisis. Of course, you would be at the maximum prior to the second crisis, but notice that we were right in the crisis in 2010 and 11, you would still be accumulating the 2.5% maximum. So, okay, that doesn't sound very good from the point of view of counter-cyclical policy, if you basically follow this indicator. So let's try to go back to the rationale. Why do the Basel people went for the credit to GDP gap? And the basic story there is that it's very good at forecasting, or is the best available variable to forecasting financial crisis. So the notation that I'm going to use, XT is as before the credit to GDP gap, or could be any other variable that you think has forecasting ability. And YT is a binary variable that is 0, 1, 0, no crisis, 1, you have a crisis in quarter T. I'm going to be using sort of quarterly data like in the pictures that I had before on Spain. The model will be one of forecasting. You want to find what's the probability that at T plus 4, i.e. in a year from now, we will be in the value of Y is going to be 1, so you're going to be in a crisis, given the information that you have today, the XT, the credit to GDP gap. And of course, a special case of this model, it would be a logit in which the f function takes this form. There are two parameters there, alpha and beta, and of course beta is the slope parameter, which is the one that is going to be multiplying the x. So that's the focus of forecasting abilities, whether this beta is significantly different from 0. Well, and positive. So the data that I'm using with this person from the Bank of Spain, Christian Castro, is the official data which has been collected by the European Systemic Risk Board, and we have 15 European countries. Charlie, you are going to be interested in this. Only 3 countries didn't have a crisis in this period, which are Austria, Belgium, and Luxembourg. All the others had one or more, and the one that had the most was the UK, which had 3. I estimated this model for the 12 countries, and what we find, if you estimate country by country, is there's a huge variation in the estimated values of the betas. So it seems that the effect of the gap on these probabilities of crisis varies a lot across countries, and in particular, notice that it's negative for 2 countries. So it actually, you should, I mean, if it is negative, and one of them is significant, by the way. Now, the range goes from minus 0.14 to 1.33. Okay, so this is kind of, if you are going to use a mechanical formula which fits the XT, the credit to GDP gap, into the buffer, then this is trouble, of course. Now, what could be done? Well, let's try to think about a better way of estimating this model, and the thing that I have in this paper that is in the making is that it seems better to condition on the current state, i.e. to think about the probability of transition into a crisis from a no crisis situation. So it would be the probability that in a year from now, in T plus 4 quarters, you are going to be in a crisis 1, conditional on the state of the gap variable today, and assuming that we are in no crisis today. So these are transition probabilities. And if you estimate that, I'm afraid not much change. So still you have a large variation in the estimated values of the beta. They are positive and significant for 9 countries. That's better, but still we have 1 country for which it doesn't work. So the assessment is the same as for the unconditional model. what happens with panel data? Let's bring the econometricians to the floor. And panel data allows for some niceties in terms of the estimation. You can easily test whether the betas are different across countries. And of course, the results for both specification, the conditional and the unconditional, is that the betas are different across countries. Not very surprising. And therefore, the conclusion is that have no change. This doesn't seem to be a very good model to build a regulation of the sort that the Basel Committee proposed. So summing up, from an early warning perspective, I think that the credit to GDP gap has some forecasting power, so I don't deny that. For most countries, you have a positive and significant coefficient, but the effect is very heterogeneous. So I think that there is no empirical basis for the countercyclical capital buffer formula, B of xt, that you find in Basel III, with the same parameters H and L for all countries, right? So I mean, if you're going to go for this, you have to have discretion as to the way in which you're going to fix the critical variable values L and L. Okay. So let me now move to the next part of the discussion. Well, I mean, we've been discussing the connection between the gap and financial crisis, to what extent this is a good forecasting variable. But what about the business cycle? Because after all, we're supposed to be concerned about pro-cyclicality in the first place. And the name of the instrument is the counter-cyclical capital buffer. How does it relate to the business cycle? Well, just what I want to show you some correlation results. I compute the rho I, which is a correlation between the gap for country I and quarter T and GDP growth over the next year, right? So this is the delta log is GDP growth from T to T plus 4. And what do we find if we take just the full sample for all countries? Well, that the minimum is very negative, is 68% minus. The max is 0.3, is 30%, but the median for these countries is minus 0.43. So wow. So basically, for almost all the countries there, we have a negative correlation. Now, negative correlation is, I mean, and then if you do a restricted sample in which you leave out the crisis quarters because you think that the gap is not doing very well, still the same result. So this is really no good. I mean, when correlation is negative for many countries, which means that the gap is going to signal to reduce capital in good times and to increase capital in bad times. I mean, no matter how good is this variable on the forecasting side, this is bad policy. I mean, period. I mean, I disagree. The Basel people don't like what I'm saying, and what can I say? I mean, this is the data is speaking for itself. So from a pro-cyclicality perspective, using the credit to GDP, I think is undesirable. It would tend to exacerbate the pro-cyclicality of regulation. So let me now conclude. I think that the pro-cyclicality problem in regulatory policy is a first-order problem. The principles laid by the G20 in 2009 have been overlooked. Supervisors have ignored macroprudential concerns. Just look at what in the European concept, the European Banking Authority has been doing. I mean, basically, you want to build credibility, increase capital requirements at the time in which the banks are in very difficult position with respect. So they basically, you have a credit crunch, and then you are concerned, whoa, we have a credit crunch. What can we do about the credit crunch? Then, of course, they've been requiring banks to hold more capital, not less capital. And so my reading of the counter-cyclical capital buffer is that it's very disappointing on the pro-cyclicality front. So what should be done? I mean, if they ask me what I would have proposed, this is what I call the first best. No? I think that I would adopt the idea of automatic stabilizers. I wrote this paper with two people from the Bank of Spain, former students of CENFI, by the way, of the place. And what we proposed there was a very simple idea. You just have I mean, since we don't know very much about the way in which capital requirements are going to interact, just have a capital multiplier, or in the jargon, a scaling factor based on GDP growth. So when you grow significantly, while you're in expansion state, you have a multiplier greater than 1, and when the growth tanks, then you just lower the multiplier, and then you can calibrate how you want to do it. But that would be a kind of a simple idea that would probably bring a lot of good into the regulation. But since we are not in the first world, what about the second best? I mean, what could be done? Well, I think that if we are not going to have something automatic, you better have some discretion by good people. So good people with authority, macroprudential authority, should be sufficiently powerful to overcome the microprudential supervisors. I think that, there is a lot of discussion about macroprudential principles, concerns. Basically, this means nothing, zero. The world and the regulators and the supervisors are run by the micropru people. The macropru is just a game for the press. We are doing something. We are concerned. At the end of the day, who carries the decisions are the microprudential people. So, but if we are going in this second best world, macroprudential authority should use a lot of judgment. And since there is no simple, shall we say, Taylor rule type formula for the countercyclical capital buffer or any similar instrument, I think because things in this area are much more complicated than monetary policy, then you just have to have very good people with very good research capabilities, which is what you are not getting. You're getting the lawyers, the accountants, and the practical people into the supervision. You are not getting the economists. And look at what is happening with the single supervisory mechanism in Frankfurt. Okay, so we are not going in the right direction in that respect either. Is there any hope? Well, maybe let's look at the other side of the Atlantic. If you look at Dodd-Frank, which for a number of reasons is not ideal, but at least on that front, they have this paragraph. It says, each federal banking agency shall seek to make the capital standards countercyclical so that the amount of capital required to be maintained by an insured depository institution increases in times of economic expansion and decreases in times of economic contraction. Wonderful. That's what we want. Is it not? Anyway, we'll see what happens with the implementation, but at least it's there. And what is there is exactly what is right, I think. Okay, well, thank you very much. This is all I have to say.
Okay, so now our panelists have graciously agreed to take questions. So please introduce yourself before you ask a question, and then indicate whether it's which of the panelists the question is for. So start with the gentleman here on the far right.
Thank you. Thank you. Really enjoyed all three presentations. Absolutely wonderful. Question for Charles. The examples that you gave, there's a small number of examples. And then, if you think, say, of Australia, it was oligopoly banking sector, regulated to within an inch of its life until the early 1980s. So nothing ever failed because they never lent to anybody who needed money. So then there's been 30 years where they have been taking some risks, but could it just be that they've been relatively lucky and that you've ended up with a small sample? At least one of those banks, one of the oligopoly banks in Australia, had to be bailed out, the Westpac. So I just wonder how robust conclusions can be that there is one small set that hasn't had the bad experiences.
And that's a very good question. So the first couple of chapters of the book, we talk about patterns across the whole world from using panel data, country-level panel data. And then at the end of the book, after we've drawn conclusions from the 5 main countries that we study longitudinally, over long periods of time, then we talk about whether those conclusions actually are borne out by looking at the whole world. So we're very much sympathetic to that, and we think that the answers are very encouraging. That is, we think these really illustrate patterns that are showing up in the referee journal articles too, but that actually we can do a little bit clearer identification by looking at it this way. Remember, Australia is not one of our subject countries. But let me tell you a little bit about Australia. So one of the benefits of looking over long periods of time is if you studied Australia, it was, by the way, one of those 6 countries that had a major solvency banking crisis from 1873 to 1913 in 1893. And it was mainly, as you I'm sure know, the Melbourne-based land boom that was promoted by the government that sort of caught the banks. So it was very much, again, a politically based and real estate based. Almost all banking crises are real estate crises. Real estate's very political. That's why it's there's that connection. But I think that what's interesting is Australia's history and all the interesting history that we were talking about is not just during the recent 30 or 40 or 50 years, but going much, much farther back. So I do think that these patterns are borne out across regimes, is a short answer. But I think the only way to get at that, of course, is to go back and do one country at a time in great detail.
Question here in the center aisle, Brianna, gentleman here with the brown jacket.
Yeah, thank you. George Selgin, University of Georgia. I had a question for Professor, or rather a comment on Professor Repoulos' very, very interesting talk. My comment is, I think you should stick to your first best guns. And my reason for saying that, and I'd like your reaction to it, is that when we look at other regulations and how they are enforced, because all regulations are enforced with some degree of discretion, we find there's a great tendency towards pro-cyclical stringency of enforcement. When things are going well, the regulators are much more lax, and then after the crisis, they tend to be much more strict. That's certainly been true since the recent crisis in the United States, and that's with no change in the rules. John Allison, in his book about the crisis in the U.S., gives some spine-tingling examples of the way regulators' behavior changed in a pro-cyclical manner in the course of the crisis. So I really worry about your discretionary alternative, that it actually could turn out to be as bad, even as bad as what the people coming up with the Basel rules have managed to come up with.
We agree. I mean, this is, but we are not going to get it. So that's.
Not going to get the second best, you mean?
You're not going to get the first best. So you may as well try to get better human capital in these places, because sometimes just having thinking people around helps decisions, even when you have politicians and lobbyists and that. I mean, getting some discipline into the policy-making process helps. That's at least my hope. But it's only a hope.
I'd like to piggyback on George's question. You know, I really accept your argument. I think that was really great, showing that the credit to GDP ratio is sort of completely misguided. But I'm not as pessimistic as you are about creating something like a rule based on something else. So let me point out that I don't understand why the Basel Committee pushed this credit to GDP ratio as the indicator. But here's what I can tell you. The Bank of England internally was looking at whether a credit growth rule as a threshold for changing capital requirements worked better than a credit to GDP rule. They found they did. The BIS, prior to the Bank of England study, Borio and Drayman showed in a couple of papers that a credit growth trigger. You found it. The De La Riccia at the IMF found it. Okay, so here's an interesting fact that brings us maybe to some political economy, which I don't understand. Everybody who's looked at rules and looked at sort of efficient information-based triggering of this, instead of relying on the recession, I agree with you, the recession would work better than the credit to GDP. But actually, I think a better rule would focus on credit growth. And De La Riccia also says you don't even have to, contrary to Borio and Drayman, include the asset price growth. It works fine, just simple credit growth, right? When credit growth gets to be above some trigger, call it, I don't know, 20% over some period of time. So here's a puzzle. How come if all these institutions, I'm not putting you on the spot, the World Bank, the IMF, the Bank of England, and the BIS itself, have these studies saying credit growth is better than credit to GDP. How come the Basel Committee is pushing this bad idea? Because maybe we could get a lot better with a credit growth rule. That's what all the research says. I don't get it.
Well,
What's the answer?
The answer is that, first, the facts, credit growth is slightly worse from the forecasting perspective. It is much, much better on the pro-cyclicality approach. So the correlation with GDP is obviously positive. So you don't make that sort of mistake in that.
Right.
Now, why? My story is that, the Basel Committee works in silos. So you have certain people that look at credit risk, then liquidity risk, operational. Then there were some people which were looking at this forecasting ability for financial crisis because that was their mandate. And within the narrow limits of that mandate, they were playing a game which was forecasting ability, period. It doesn't matter whether the variable was very poor as a forecaster, because forecasting crisis is not very easy. But the moment you have some marginal gain in forecasting ability, that was it. I mean, you didn't introduce any other consideration. That was the name of the game, period. Credit growth would be much better. And the amazing thing is that, I mean, despite all these Bank of England and academic researchers, it's defeated. And in Europe, it's not just the Basel Committee recommendation, it is in the directive, right? So it's not that we are sort of, after all, the Basel Committee recommendations can be changed in going to the national legislation or the European legislation. Well, it hasn't changed. The gap is mentioned in the directive in Europe. It is not mentioned in the US, so that's why the US is much better in that respect.
So, I mean, my own... When I talk to regulators, and I won't quote any of them or even their institutions, they've told me privately that they're planning to focus more on the credit growth to the extent that they can. But, I mean, you're right, though. There's a directive.
Yeah.
What are they supposed to do about that?
Well, I mean...
We don't want to monopolize the conversation. Why can't we change that?
It's very interesting.
I'm Joseph Moriali from Pace University in New York City, Professor Columbus.
I'm sorry?
I've got a kind of a two-pronged question, which probably will involve Professor Columbus and Rapullo. And it goes like this. Professor Columbus, you said that the United States policy and structure was basically the same from the 1830s to 1980. Now, I teach American economic history, and we usually talk about the incredible structural reforms in the 1930s that lasted till the 1980s because of the Great Depression. So that struck me as either broad-stroked or something that I don't recognize, since I would break it up into two sections with the incredible reforms that were established in the 1930s, which did seem to work until we deregulated in the 1980s. Okay, that's one thing. The second thing, perhaps more for Professor Rapullo, is this. If you're looking for enlightened monetarists who can do monetary policy, how do you explain Chairman Greenspan's position that he recanted his policy after he stepped down his chair, arguing that, well, he was actually too liberal and wasn't regulatory enough? I just find that amazing. So I'd like sort of a two-prong.
So remember that the topic that we're talking about is the history of banking instability in the U.S. So let's look at first of all, where was that instability? Pretty much, if we're talking about insolvency instability, it was in agricultural areas. Agricultural areas in the 1890s, for example, in the 1920s, and then even bigger in the early 1930s. New York banks, who were affected by, for example, the separation of commercial banking from investment banking in 1933, were not part of the instability problem, and were really changes in their business plans, which I'll grant you there was some change in the 30s, really wasn't relevant for changing the structure that I'm pointing out, which has to do with unit banking. Now, what happened in the 30s, in fact, was very explicitly a political deal to preserve unit banking. In other words, to preserve the status quo. And that deal had one major element, which was bringing in very limited federal deposit insurance. And of course, Franklin Roosevelt opposed it. He opposed it in his 1932 election. He opposed it after he became president because he had just witnessed 8 states that had failed to establish a successful deposit insurance system that all collapsed around 1921. Everybody around then knew that deposit insurance was a bad idea. The Treasury Secretary was against it. The Fed was against it. Roosevelt was against it. Carter Glass was against it, but Henry Stiegel from Alabama, a big unit banking supporter, was in favor of it. So was Huey Long. And of course, William Jennings Bryan was among the first to propose federal deposit insurance, if you're catching the drift. This was a unit bank preservation, risky rural unit bank preservation measure. There were 150 attempts to do it from 1884. It finally was passed as a so-called temporary measure for very small deposits, read rural bank deposits, in 1933. What it did was basically, we were about to get rid of the unit banking system if we didn't pass federal deposit insurance. Federal deposit insurance basically prevented a change in the system. So the real continuity of the instability of the U.S. banking system was the continuity of unit banking, which the 1930s political compromise actually preserved that and created that continuity until it came apart in the 1980s. That's the basic history I'm talking about. Yeah, I'm sorry to go on for so long.
No, I think that probably, Charlie, you are in a better position to answer the question on Greenspan. Let me just say that there's a very important debate about monetary policy, Fed's monetary policy prior to the crisis and whether interest rates were kept too low for too long. But let me note that there is a competing hypothesis there, which is the global savings glut, and to what extent it was not Fed's policy, but the fact that the Chinese were sort of buying all kinds of assets, especially safe assets in the U.S., and what did the impact of that on real interest rates. So I don't know, maybe you want to say something on that.
Yes. So, again, this is taking us a little outside the U.S. context, but it's a perfectly legitimate question to ask. Well, there's some countries other than the U.S. that seem to be undertaking a lot of risk then. And what's driving those countries? I think in Spain, we have a pretty good sense that there's also a political story underlying what's going on in housing. But I think that it's too simple to say that it's the cajas and the local governments that are driving them. That's certainly part of the story. But I have an alternative model, which I've written about, but I'm developing further, which is taking us back to simple real exchange rate theory. So what does the Harald Balassa-Samuelson theory tell us happens if you put together, as in a currency union, low productivity growth countries, Portugal, Spain, Greece, Ireland maybe, with high productivity growth countries, let's just say Germany, the Netherlands. What's going to happen is the tradable goods production in the low productivity growth countries is going to be stalling. And so now you're a government. What are you going to do about that? You're going to react to it. How do you react to it? Well, you can either give cheap credit or you can do fiscal expenditures. Which sectors are you going to be able to prop up when you do that expansion? Non-tradable sectors. What is non-tradable? It's called housing. So if you think about the political economy of what's going on in the housing booms that are credit fueled or fiscal policy fueled in those countries, it's a similar, it's also a political economy story about misaligned policies in a currency union or misappropriate currency unions. So that's a different political story, but that's the one I've been telling.
Thank you very much. Deeply impressed with the actual.
Please identify who you are.
Yeah. Okay. Yes. Regardless of school situation, any kind of data, we completely agree with the actual wonderful analysis by three speakers. Indeed, deeply impressed. And short comment. Yeah. Consumption multiplier. Net investment multiplier, tax multiplier, technological multiplier. These are independent with each other, so that this, if these are each stable, then banking crisis does not occur, or less. But you mentioned mentioned that Central and East, South America and some countries are unstable, including Ukraine, Turkey, and some others. That is the stage from net investment to consumption is unstable and suddenly changing to up and down, so that the banking crisis occur repeatedly, back and forth, very sharply, and without repeating the same circumstances anymore, always changing. So, and one more, yes, policies, all the policies must be moderate between left and right political powers. So that is moderation is most important.
Let me talk about that, that one point, if I could.
Yes.
You know, what's interesting about the U.S. was that during the coalition, the Agrarian Unit Banker political coalition, these are two groups who hate each other, and they're not part of the same political parties. And if you read The Grapes of Wrath, you'll see how much the agrarian landowners hate the bankers. They're not part of the same party. It's a great political stable partnership precisely because it's immune to partisan changes having to do with the election. Similarly, in the recent 20-year period, urban activist groups and too big to fail bankers aren't best friends either. So some of the key political players, for example, Newt Gingrich in the United States, who represents suburban Atlanta, what this illustrates is this isn't just a coalition of poor inner city people and too big to fail bankers. It's not just a coalition of the Democratic Party and too big to fail bankers. It's really a coalition of urban interests versus rural interests. And that's the real divide. In the earlier period, it was rural dominant. Now it's urban dominant. But so it's not a political partisan issue, which is quite interesting. The way political scientists tend to think about coalitions is always within these political parties. But the best coalitions, the most stable ones, are across them. Sure.
Marlene Kim, University of Massachusetts. I thought this panel was amazing too, so I have questions to two of the panelists. For Asla, I was wondering, I get that you think prudent policy with transparency and information is the key. So I'm assuming you are in favor of regulating hedge funds in the United States, maybe having capital requirements, more transparency. So I'm wondering what that might look like if you think that's true. I'm also wondering, given that there wasn't adequate regulation and transparency once the bank started to fail in the U.S., what you would have done. Would you have let them fail? Would you have helped the mortgage owners more? Given that there was a problem, what would you have done differently if you were in charge? For Charles, I thought very thought-provoking thesis. I think you're right, the politics is the missing link. And I was surprised, though, that the activists were the motivating force, because I know a lot of these groups, and I think they'd be surprised that they had that much power. So I'm just wondering if, during the same time from the 1980s to the present, we also had lax campaign finance, and money being a lot more important in elections instead of traditional people going out and voting, and so that money could speak louder than the number of people and the traditional voting, get out the vote mechanisms. We also had deregulation. So I'm just wondering if that, what you think about that as an alternative explanation, or contributing explanation. The other thing is, I was surprised by the number of banking crises you had listed. I didn't know there were so many. I'm wondering how you defined them and how you counted them. I was especially surprised there were more in the recent period than before. I don't remember that many banking crises, so I'm curious how they were defined. And one of the things I'm wondering is, when I was in Sturbridge Village recently, I saw all these banknotes from the banks and was told that the banks just failed and you were stuck with bad money. So I assume that was not counted as a bank failure because it was limited to individuals. But I'm not sure if you counted it or not. But what was different back then is, even if these banks failed, we didn't have a national economy then, so that the crisis would not have been as big. So it seems like even if the charter banks were political earlier on, which I assume they were, maybe there wasn't as much effect, so that you had to have a national economy to have a crisis, so that would bias the estimates towards the later period.
Thanks for telling me that.
Okay, very briefly on what to do during the crisis. Of course, it's a very difficult thing when there is a panic. It's very difficult to figure out what to do, but it is important to do the right thing, because what we do during the crisis also influences very much the incentives environment going forward. So one of the things that's important is to identify those institutions that are truly insolvent and not necessarily continue to provide funding and bailing them out. So even during the bailout period, it's important to be able to sort of identify through perhaps the stress tests on other mechanisms, those institutions that you are willing to stand behind, those which are liquidity constrained, so to speak, versus those that are truly insolvent that you need to cut off and let fail or resolve. Part of the solution going forward is presumably to remove this too big to fail issue, because if you do have institutions that are deemed to be too big to fail under any circumstances, this sets up an environment that it becomes extremely difficult to regulate, because the incentives are so distorted. Unfortunately, given what's been happening after the crisis, it has become even more difficult to deal with this issue, because we haven't been able to address the too big to fail issue as effectively as we perhaps could have. On the hedge funds, I think I'm going to pass that to you. You're much better off.
Well, we don't have a lot of time, because I know the session's starting at 5:15, and I don't want to monopolize it, but those are all good questions, so I'm just going to give you like the answer quickly to all of them. Isn't it remarkable that urban activist groups could wield a lot of power? Well, yes and no, because again, they're not just benefiting themselves, but although they are in their constituents, but they're also having an effect on the entire urban environment, which is why people like Newt Gingrich, I think, were probably favorably disposed to it. The details of how they did it are also quite interesting. And they also were very much involved in the GSE Act in 1992, by the way, signed by George H.W. Bush as part of his presidential campaign. So again, it's not just a Democrat issue. So I can't really go into all the detail there, except to say what's really important is when the GSEs relax their underwriting standards in order to satisfy all this growing debt, they have to do it for everyone. So again, it's not just affecting mortgages in the inner cities. It's affecting all the mortgages, because when they are forced, in order to meet these mandates, to change their underwriting standards, those apply to everyone, which is why it becomes so big a problem. So now about deregulation, I don't think that that's a big issue. I think the bigger issue was the decision to allow the regulations not to be enforced and to change the capital standards. The big sort of relaxations of regulations were in the 1992 Act for Fannie and Freddie, and also in the securitization treatment of the bank's mortgages. So the real changes were not this sort of investment banking stuff. No, I don't think that's true at all, in fact. In fact, in 2002, investment banks became regulated under Basel for the first time. So it's not really a deregulation story. It's a bad regulation story. And I think giving those banks and the GSEs concessions because it was the way to get the political deal to happen. You would think, under finance theory, if you're going to take more risk, you have to have more capital. But the political deal is, if you'll take on more risk, I'll let you have less capital. That is the crucial point. How do we define crises? Levin and Valencia IMF study is a good place to start, but I'm out of time, so I better stop there. Thanks for your questions. Oh, campaign finance, yes, and we talked a little bit about that. The biggest 5 recipients from the GSEs, who were major players, the big players in campaign finance, were, prior to the crisis, Barack Obama, Joe Biden, Dodd, Frank, and Schumer.
and now let's thank our panelists.